Hey everybody, welcome to Connect in Cannabis, brought to you by Wrazel. I'm your host, Brian Holler. Today we have Jeff Elkins with us. He's Senior Tax Manager at Hall & Company CPAs. We're going to be talking a little bit about accounting and how it applies to cannabis companies, but mainly we'll be digging into the recent TIGTA report. And if you don't know what TIGTA is, we'll tell you. That came out about the marijuana industry. But of course, I have to talk about our sponsor for this episode, Ojai Energetics. Ojai Energetics has the most advanced water-soluble CBD on the market. Its fast-acting, most viable products are made without synthetics. Most users feel the benefits with proper dosage in under 30 seconds, not 30 minutes like a regular CBD-rich oil. Their products are created using organic ingredients and regenerated farming practices, benefiting both people and the planet. Ojai Energetics provides CBD users with a dependable bridge to optimal living, promoting everyday health and healing. To see their products, visit OjaiEnergetics.com, and to learn more about their current investment opportunity, visit their profile on the Wrazel investment marketplace at Wrazel.com. Jeff, thank you so much for being here today, my friend. I appreciate it.
Brian, happy to be here, and thanks for the intro.
Of course. My pleasure. My pleasure. So, Jeff, you're Senior Tax Manager at Hall & Company. Let's talk a little bit generally about Hall & Company. Where are you guys located, and what industries do you serve? Is it only cannabis or more?
Sure. So Hall & Company is a full-service CPA firm based out of Southern California. We're in Irvine. And we serve a variety of industries, and we serve them in any capacity we can, whether it's from an accounting, tax, audit, advisory services. So it's pretty good. We also have a specialization in cannabis, which is why we're here today, but we do serve other industries as well.
Yep, very, 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 very cool. I think it's also important to note that you guys are a full-service accounting agency. Can you talk a little bit about being full-service versus maybe some other alternative types of business models?
Sure. So, when we say full-service, what we mean is that we have a lot of ancillary services that other firms may outsource. We have that in-house. So if you're doing research and development, we have an R&D specialist who can help get credits for those expenses. And we have internal bookkeeping and accounting departments, cost segregation and other services that you typically don't find at a firm this size. We have in-house so that it's kind of a one-stop shop for our clients.
Very, very cool. Of course, and obviously, if any of you out there are in need of accounting, go check out Hall & Company, reach out, and they'd be happy to talk to you and help you, I'm sure. But of course, today, we want to talk really specifically about a recent report that came out from TIGTA about the marijuana industry. Let's start with the obvious. Jeff, what's TIGTA?
TIGTA is the Treasury Inspector General for Tax Administration. And what they did with this report was they basically went in and audited the IRS's own efforts in ensuring compliance for the industry. And what they found was pretty alarming. And it should be of note to both tax practitioners and cannabis industry business owners and operatives as well.
Sure. And I guess let's dig into some of those findings. So first of all, you said they analyzed a handful of states, I believe, to see about 280E compliance. So let's start here. What is 280E?
So Section 280E is part of the Internal Revenue Code, and it basically says that you're not allowed to deduct any expense other than your cost of goods sold for any business trafficking in a controlled substance. So what that means for marijuana companies is that outside of your cost of goods sold, which in itself is a complex and detailed arena,
yes.
You're not going to get to deduct your general business expenses like any other company would. Your marketing, your sales costs, etc. Those are all expenses that are completely lost for cannabis companies.
Yep. So they looked at that compliance in California, Washington, Oregon, correct?
Correct. Yeah. So the Western region, and we can expand on this a little later, but that's just one reason why the findings in this report were so alarming, because the underreporting rate, the lack of compliance was very significant, and they only looked at 3 states. Now you've got, I think it's something like 33 states that have either legalized for recreational or medicinal purposes. They've legalized cannabis, and so you take the results from 3 states and now expand 11 times that. And it just really shows that this is an area that the IRS is going to increasingly look at because there's a lot of money left on the table.
That makes a lot of sense. And so that's a big heads up for folks out there, not just in those states as well, correct?
Yes, absolutely.
Yes, absolutely. So what did they find, right? So what were some of the high-level findings in the report, Jeff?
Well, so what they did was they took a look at tax returns that were filed in the marijuana industry. They looked at 237 returns, and they found that of the 237, 140 were not 280E compliant. That's 59% of the returns they looked at were not in compliance with Section 280E, meaning they over or under included their expenses, which what it does is it paints a target on the industry, because when the IRS sees a statistic like this, they just know that there's more money on the table. Yeah. And in fact, in the report, they even quantified that. They said that based on these findings alone, the 5-year forecast was missing revenue for the Treasury of almost $250 million, almost $250 million. And that's a lot of money in its own right. Yes. But when you take into consideration that this was, when they did that forecast, they weren't expanding for other states that have since adopted legalization. Right. And in fact, they weren't accounting for recreational legalization at all, because the returns they looked at were from the 2016 tax year. So all they did was they took the 2016 tax year and multiplied that out. So, as you know, the industry has just blown up since then. And of course that $250 million number is way under.
Oh, way, yes. It must be. Could part of the reason for all of this be just all the confusion around how to do it in the first place because of all the different regulations? Like it's easier, obviously, as you were stating earlier, in other industries because you don't have to worry about, this is covered, this isn't, that sort of thing. Or, what might be some of the reasons behind 59%? That's a big number.
Yeah, so, it's there's a lot of reasons.
Sure.
One is just lack of information. Yep. The IRS itself hasn't really issued any guidance on how compliance works or what that looks like for the cannabis industry. So it's really been on the professionals to really dig in and determine what is cost of goods sold, what do the regulations say, and then look at the outcome of audits and other analysis that the IRS has done, always after the fact, of course. So sometimes, business owners are going in blind with an idea saying, look, we hope this works, we've got a basis for it, but absent, industry guidance from the IRS, there's a lot of areas that are unknown. So that's one factor. And another factor is, is using preparers that are not well versed in the area or maybe under researched and getting just poor advice.
Right. That makes sense. So those are two reasons that seem very logical for, why it would be confusing. I just want to make sure that, it's not necessarily nefarious. It's more just confusion on both ends around how to kind of proceed. Is that a better way to characterize it?
Yeah, absolutely. So, and to your point about this being nefarious, so when the IRS identified these companies that they were going to look at, they did it based on marijuana business lists from the state's websites. So, that's assumption one, is that those, the businesses that are listed there are the ones that want to be compliant. They're the ones that are trying their best to comply with all the applicable laws.
They're actually submitting their taxes. So
exactly. They didn't even look at gray market or illicit operations. That's 59% non-compliance on the companies that are trying to be compliant.
That's right. And so that's a great clarification, Jeff, because it really does speak to the reasoning you were giving earlier about just a lot of confusion, lots of stuff going fast and trying to, catch up with it, lots of weird, interesting regulations because of how, cannabis is being rolled out essentially.
Yeah. And that's something too, we see with a lot of our cannabis clients is that, these are people who are, the industry may have a reputation outside of cannabis, where maybe viewed as
Sure.
just lazy potheads or something like that. But our experience has been that the clients we're working with are very professional. They love the industry, but they want to create a profitable business. They want to give back to their communities, and they want to be compliant with all the laws. So, the IRS doesn't make it easy for them, though.
No, they don't, and that's you bring up a good point, because at Wrazel, that's a lot of that's a piece certainly of getting a company buttoned up or getting them in a place where they need to make sure they're compliant, make sure they're doing things kind of by the book. And I can echo your sentiments completely. I have met a lot of people from a lot of different walks of life in cannabis. Everybody is trying to be the best, do the best they can. They're trying to be as professional as possible. They're trying to learn as quickly as possible and be efficient like that. And they want community. People want to be together and to really make sure that this works. It's tough. There's a lot of moving parts.
Right.
Yep. Let's get into it. So they had the findings, and so now they report recommendations for moving forward, correct?
Right, they did. So out of the report, they identified 6 recommendations. And again, this is the TIGTA agency making recommendations to the IRS commissioner for areas they can improve their outreach and compliance in the cannabis industries. And most of those recommendations circled around two areas. It's educational outreach, because they acknowledge that the IRS guidance on 280E in the industry as a whole is really non-existent. Sure. So educational outreach, that was a big one. And then also increasing efforts for identifying non-compliant taxpayers, which, to interpret it a different way, do more audits, right? Because it's easy money for the IRS, given the under-compliance rate. They know that if, and I don't have the stat off the top of my head, but the IRS analyzes the benefit, the dollar benefit for an hour spent on an audit. And if dollar benefit for a cannabis audit compared to a standard industry audit is something like 3-4 times what you get as a return. Yep. So the IRS looks at this like any other business, right? What's the return on investment we're going to get? And the return on investment for cannabis audits is significantly higher than any other type of audit that they have going on.
That is a very, very strong point for everybody out there to understand. They're in a sense a business too, and they're going to go after what they know is going to get them the most revenue too. And so, go ahead. Well,
go ahead. And I think that the takeaway for that for people operating this space is that it's important to be compliant. And again, like we talked about, people are trying to do that. But as far as what can you do to better your compliance efforts? One, it's working with people who know what they're doing, but it's also it's keeping good books and records. That's important for any business in any industry, but it's doubly so for cannabis, because not only are you going to have this high rate of audit, but because of the nature of the business and 280E, the game is how can we get as much as we can into cost of sales, and do so legally. Yep. But what that means is that you have to keep better records than anyone else, because those records are your support. If you have some just regular manufacturer, if a cost is an inventory, that's okay, because they can deduct it as a regular business expense. But cannabis companies don't have that ability, so it's super important to be able to substantiate any cost that you put on that tax return.
That makes a lot of sense. And again, that's a theme of my show. I got to tell you, especially since coronavirus is certainly having a lot of people kind of looking under the hood, examining what they can and can't do, that sort of thing. Right. This is definitely part of that. This is a great time for you to make sure that you are, we like to call it buttoned up, but just really, really dialed in. And like Jeff just said, is it fair? No, but it is what it is. And you really do need to put a lot of emphasis on protecting yourself and your company. And working with somebody like a Hall & Company or another accounting firm is going to help you in that direction quite a lot.
Yeah, absolutely.
Yep. Let's see. We talked about the notable mentions. Oh, wait, there's one more, I think, notable recommendation mentioned, I think, like a loophole for small businesses, right?
Right. Yeah. And this one's pretty significant. And maybe, let me go through a couple of the other ones, right, first.
Sure.
I'll save that for a minute. But so items of note, right? They identified that they haven't offered much guidance and people are kind of flying blind. So that was one takeaway, is that's an area they're going to improve. And that's a good outcome from this report, is that, that hopefully the industry gets better information.
Right.
It also, went through some of the standard inventoriable costs, right? What is an expense? What's not an expense that can be deducted for cannabis companies? Things like your interest, your selling expense. Those are things the IRS actually frowns upon. You hear like interest and rent a lot of times,
right,
as costs that people are very aggressive about, and not that those are completely off the table, but it's important to know the IRS's position on some of these, especially with regard to depreciation too. I won't get too technical here, but there's depreciation. That's another kind of no-brainer that a lot of people are just put that on your return and go with it. But there's really considerations there too. What type of depreciation? What's the recovery period, and how quickly are you recouping your investment on that asset? And the IRS thoughts about that as well. So there's really a lot of details here that people need to be thinking about, just even on some of the run-of-the-mill items.
Right. Yeah. I mean, it definitely does sound like, people really, really do need to, especially cannabis business owners, need to really examine all the different possible ways that they might be able to recoup some expenses,
Absolutely.
Yeah.
And then now, into this loophole. And, I always tell people that there are very few loopholes in the tax code. For the most part, what people think of as a loophole is actually a well-defined and specific section that was written into the code, maybe by, lobbyist efforts or something like that. But, they're very intentional with how they write the revenue code. So things don't often make it in there by accident, but this appears to have, and it's oddly enough one that was, identified by the IRS in their own report. And I think that's very significant. And I'll get back into the recommendation piece at the here in a second, but basically, this was a loophole that came out of the Tax Cuts and Jobs Act that went into effect at the end of 2017. So this is really the second year now that you might see this having an effect for businesses. But basically, it's a loophole under 471C. So for those of you at home with your Internal Revenue Code trying to keep up with the revenue, 471C, and what it says is that small business taxpayers under a certain gross receipt threshold. It's 25 million, and that's indexed for inflation, so it's up to 26 million this year. But basically, small business taxpayers under that gross receipts threshold, if they do not have what's called an applicable financial statement, and that's generally going to be your audited or reviewed financial statements. Right. So if you don't have those and you are under that gross receipts threshold, you're allowed to maintain inventory and report it on your tax return using any method that you want on your books and records, and it will not be deemed to incorrectly state your income. And that is super important, because what that means is that you can use a method of accounting for inventory that puts all of your expenses into cost of goods sold. So that's not something that the code and regs would allow. So that's why this is kind of a new thing, right? But a small business exception that was aimed at relieving some of the administrative burden for traditional industries, so that they don't have to go through the process of detailed inventory tracking like a cannabis company does. Yeah. And one of the unintended consequences here appears to be that on the flip side. So rather than just disregarding and saying, hey, we're not going to account for inventory, we're just going to write all that off as just an operating expense. Right. The flip side is it appears to let cannabis companies do the opposite and say, we're going to say everything is an inventoriable cost. And what that means is everything in inventory, everything runs through cost of sales. So the effect is that you circumvent 280E entirely.
Yep.
And that is huge.
It is a big deal.
And I'll say,
yeah,
go ahead.
Basically, that is the textbook definition of a loophole, because you could take all the things that 280E prevents you from doing and funnel them, through this mechanism, essentially.
Right, and the way the language reads is important too. It says that this method, as long as you meet the criteria, will not be deemed to incorrectly reflect income. So what that does is it's just more ammo for your audit, for your court case. Because what's going to happen with this? Is someone's going to have to take this to court.
Cool.
This is a new thing. As far as I'm aware, it has never been challenged in audit,
right.
and certainly in court. Yeah. So, someone's going to have to be the first one to do that. But, at Hall & Company, when we identified this, we've spoken with attorneys and other industry professionals trying to pick their brain and get a sense of what the industry is doing. And there's really a lot of hype right now about this. A lot of people that are really fully on board, and even a lot of attorneys who have analyzed and said that, looking at this from a trial perspective, the language is clear. This is something that they believe will hold up in court. So that's where it's at. There's no guarantees here, of course, but a couple of key points here is that, one, the IRS identified that this was a potential outcome of that section that was amended by the Tax Cuts and Jobs Act. So they know it's there. Right. And then back to the recommendations, I mentioned that the TIGTA agency that issued this report also issued recommendations to the commissioner. And right. One of those recommendations was for the IRS to provide clarity on whether they thought that this loophole under 471C would apply. And of the 6 recommendations that were identified in the report, this was the only recommendation that the IRS said, no, no thanks, we're not gonna do that. So, and what that kind of tells us is that they think that there's maybe a reasonable basis for this in court as well, because it would be very easy for them to say, yeah, okay, we'll follow that recommendation and we will issue guidance. The guidance is that's not going to work. You're still going to have to apply 280E and you're going to lose all of your non-COGS expenses, but they didn't. And they also, of course, didn't say, yes, open the floodgates and so their silence on the issue really kind of just gives a little clarity to what they're thinking here.
Very interesting. And for those, that is 471C. So 471C for anybody out there who's kind of looking at that. And of course, this is a good segue to start wrapping up, because who can help you analyze whether that fit is a good fit for you? Hall & Company, of course. So, sure. Jeff, if you could let us know where everybody out there can find you and Hall & Company.
Yeah, of course, we're online. I'm on LinkedIn. Yeah, you can shoot me an email, je@hallcpas.com, and happy to reach out and answer any questions you have. So again, that's JE, my initials, Jeff Elkins, at hallcpas.com.
Excellent. And of course, you can also find them on the services index of Wrazel. So if you are a service provider of any kind, accountant, lawyer, marketing agency, etc., consultant, please look at that the Wrazel services index for that at wrazel.com. Jeff, thank you so much for being here. That was very, very informative, and I very much enjoyed our discussion. I think we did a good job of making a topic that could be a little bit snoozy, a little interesting, especially if you're thinking about those buttoning yourself up, and that there is a little bit of hope there. And I like that we ended it with a little bit of a hopeful situation. Jeff, thank you so much for being here. Look forward to doing it again soon.
Absolutely. Thanks, Brian.
You got it. Take care, man.